ETF and index fund look the same, but small differences decide your results. You can invest in the same market, get similar returns, and still end up with very different outcomes. The reason is not the market, it's how you invest. And one of these quietly wins for most people, but not in the way you think. First, look at index funds are priced once a day, so you make one decision and move on. ETFs trade like stocks, so you can buy and sell anytime during the day. Index funds reduce the urge to react, while ETFs give flexibility. Winner, index fund for discipline, ETF for flexibility. Let's look at management style. Most ETFs and index funds are passively managed, meaning they track the market instead of trying to beat it. Some funds are actively managed, but they usually cost more and don't consistently outperform. For example, $10,000 invested for 30 years can grow to around $76,000 at 0.3% fees, but only about $57,000 at 1% fees. That's roughly $19,000 lost just in fees. Fees compound against you. Winner, ETF, slightly lower fees, but cheaper doesn't always mean better. Now see taxes. Both ETFs and index funds can pay distributions, and you may pay tax even if you don't sell. Some ETFs can be more tax efficient depending on structure, but it is not guaranteed. Winner, depends. Slight edge to ETF in some cases, but this is not what decides the outcome. There is one more thing. ETFs have a bid-ask spread, which is the small gap between buying and selling price. It may look small, but it adds up over time. Index funds generally don't have this trading spread. Winner, index fund. Another small edge most people ignore. And now the real question is, which one actually wins in real life? For beginners, index funds often win because they reduce mistakes. For disciplined investors, ETFs can match or slightly outperform. In the next part, we'll break down how to actually choose an ETF, because not all investments are the same. Companies are generally divided into three types: large companies that are stable and well-established, medium companies that are growing, and small companies that carry higher risk but also higher growth potential. Choosing the wrong mix can completely change your results, so don't miss the next part.